6.3 Good and Bad Earnings Growth. In this section, we will take our simplified view of the future for Ryman Healthcare a bit further by considering the effects of a change in the way Ryman Healthcare is financed. We will see how it is possible to grow the earnings of Ryman Healthcare, as measured by return on equity, ROE, by increasing its leverage. This is one of a number of ways in which earnings can be increased without changing the economic and business drivers of a firm's operations, without getting involved in the messy and difficult task of adding value to various stakeholders of a firm, such as its customers. A question we will ask ourselves in this section is whether it is possible to add value to a firm's equity investors by a change in a firm's leverage. Change in leverage. If we change the way a firm is financed, what will happen? Let us assume we increase the gearing of Ryman Healthcare by increasing its borrowings by $637.5 million from $2,287.1 million to $2,924.6 million. These funds are used to decrease equity by $637.5 million by the firm repurchasing 50 million of its shares at $12.75 per share, leaving the firm with 450 million shares on issue. Note that the shares are repurchased at our estimate of their value, based on our simplified illustration of no growth, of $12.75 per share. No more, no less. There is no transfer of value between those equity investors whose shares were repurchased by the firm and those equity investors whose shares were not. The firm will continue to have net operating assets of $5,116.3 million in 2021, but these will now be financed by $2,924.6 million of net financial obligations, NFO, and $2,191.7 million of equity. That is $2,829.2 million minus $637.5 million. There has simply been a change in how the firm's existing net operating assets are financed between debt and equity. Quite a significant change, with its financial leverage, FLEV, of net financial obligations divided by equity, which is based on book values, increasing from 0.81 times to 1.13 times. The firm's abnormal operating income will be unchanged by the change in financing and will remain at $281.5 million each year. The present value of abnormal operating income will also be unchanged at $3,518.1 million, as will the cost of capital for operations be unchanged at 8%, being unaffected by any change in gearing. The value of equity would be $5,709.8 million, $2,191.7 million plus $3,518.1 million. The value per share, with 450 million shares outstanding, would be about $12.75 per share, after allowing for some rounding errors. The value per share would be unaffected by this change in gearing of the firm. We look at value of equity per share rather than in total, as the total amount of equity has been reduced by the refinancing. This is all very well when valuing a firm using abnormal operating income, as how a firm is financed will not affect its operating income. But what happens when we value a firm using abnormal earnings, AE, as earnings after interest will be affected by changes in how a firm is financed? The change in leverage for Ryman Healthcare in our simplified illustration results in operating income, OI, each year remaining unchanged at $647.6 million. However, net financial expenses, NFE, will increase because of the additional borrowings of $637.5 million. Based on a net borrowing cost NBC of 0.4%, the increase in net financial expenses because of the additional borrowings would be $2.8 million. 0.4% times $637.5 million. As a result, net financial expenses would increase from $8.8 million to $11.6 million. And comprehensive income, CI, which is after net financial expenses, will reduce by $2.8 million each year from $638.8 million to $636.0 million. Nevertheless, with the reduced amount of equity capital, return on equity for Ryman Healthcare would increase from 24.9% to 29.0%, calculated as $636.0 million divided by 2,191.7 million. We have assumed for simplicity that the net borrowing cost after tax NBC remains unchanged at 0.4%, even though we have increased debt substantially. However, the cost of capital for equity will increase. We can calculate the firm's cost of capital for equity as follows. ROE equals weighted average cost of capital plus value of debt divided by value of equity times weighted average cost of capital minus ROD, which equals 8% plus 3.9%, which equals 11.9%. Because of increasing its gearing, Ryman Healthcare's cost of capital for equity would have increased from 9.4% to 11.9%. Abnormal earnings, AE, for the firm would also increase slightly from $372.1 million to $375.7 million as follows. Abnormal earnings equals return on equity minus ROE minus 1, all times book value, which equals 29.0% minus 11.9%, times 2,191.7 equals $375.7 million. The present value of abnormal earnings would then be $3,164.6 million, calculated as a perpetuity, 375.7 divided by 11.9%. The value of equity would then equal value of equity equals book value of equity plus present value of abnormal earnings, which equals 2,565.1 million plus 3,164.6 million, which equals $5,729.7 million. This gives a value per share on 450 million shares of about $12.75 per share. We see the valuation of Ryman Healthcare as the same, whether we use discounted abnormal operating income or discounted abnormal earnings, AE, regardless of changes in the gearing or leverage in our simplified illustration using Ryman Healthcare. Consider again why this might be so. Why might value of equity equals book value of equity plus present value of abnormal operating income equal the book value of equity plus the present value of abnormal earnings, AE? This will be the case if the financial activities of a firm do not add value, or in other words, if the net financial assets or obligations of a firm are at market value on its balance sheet. If a firm can add significant value through its financial activities, focusing on abnormal operating income will exclude some value. However, if a firm is not adding value through its financial activities, ignoring financial activities will make our task of analysing a firm simpler and more focused, without ignoring any material aspect of value for equity investors. We have seen that a firm's cost of capital for equity will be determined by its operational risk, as reflected in its cost of capital for operations, WACC, or weighted average cost of capital, and by its financial risk, as reflected in its leverage, value of debt to the value of equity, and spread, weighted average cost of capital minus ROD. Yet how is a firm's operational risk reflected in its cost of capital for operations? It is through the operation of the capital markets and the returns required by equity and debt investors for the level of operational and financial risk they assume when investing in a firm. In this way, a firm's cost of capital for operations, weighted average cost of capital for equity, ROE, and cost of capital for debt, ROD, interact with each other. In this sense, each of a firm's WACC, ROE and ROD are the weighted average cost of capital of each other. Sources of earnings growth. We hold these truths to be self-evident, that all men are created equal. US Declaration of Independence, July 4, 1776. 77 years ago, our fathers brought forth on this continent a new nation, conceived in liberty, and dedicated to the proposition that all men are created equal. Abraham Lincoln, 1863. The founding fathers of the United States of America may have been committed to the notion that every person is created equal. However, how well this exists in practice, given there is a huge divide between the haves and have-nots in our world, between the oppressed and the oppressors, between the weak and the powerful, may be arguable. However, it is certainly not true when it comes to earnings growth. Not all earnings growth is created equal. There is good earnings growth and bad earnings growth. Earnings growth that adds value to equity investors and that which does not. There is earnings growth that we should be prepared to pay for and that which we should not. We need to be careful that we do not pay for earnings growth that does not add value. We need to be careful we are not deceived by earnings growth that is not the genuine thing. We have seen that the value of equity in a firm is based on the present value of all the future dividends a firm provides its equity investors, including any return of capital on liquidation or any proceeds received if a firm is taken over. Cash flows and earnings are related to dividends, so the value of equity of a firm can be equally seen as related to the present value of the future cash flows or earnings of a firm. If a firm's earnings are expected to grow strongly in the future, then its value would be greater than if its earnings were not expected to grow as strongly. Well, yes and no. Indeed, accounting earnings can be manufactured in several ways without there having been a change in the underlying economic and business realities of a firm. These are forms of imitation earnings growth that do not add value to equity investors. The way a firm's operations are financed, its leverage or gearing, can generate growth in earnings, but may not normally add value to equity investors. In section 6.2 above, with our illustration of Ryman Healthcare with two different levels of gearing, the operations of the firm were the same in either case. The value of equity in Ryman Healthcare in both cases was the same, $12.75 per share. However, with the extra leverage, return on equity, ROE, for Ryman Healthcare increased from 24.9% to 29.0%. My younger son is 28 years old. At a return of 24.9% over the next 3 years, my son's current share portfolio, valued at about $150,000, would grow to about $290,000. That is, by the time he was 31 and perhaps starting a career, settling down and perhaps wanting to buy a house. Not a bad amount to have. And at a return of 29.0%, it would grow to about $320,000 over the next 3 years. A handy extra $30,000. There is a material difference between a return on equity ROE of 24.9% and 29.0%, although both are excellent rates of return. In our illustration in section 6.2 above, the only difference between Ryman Healthcare earning a return on equity of 24.9% or 29.0% was a difference in the firm's leverage. Increasing its return on equity involved Ryman Healthcare borrowing $637.5 million from the bank and buying back 50 million shares. Is it really that easy for a firm to enrich its equity investors? As we have seen above, how a firm finances its operations can change its return on equity, but not a firm's value if the changes in return on equity are exactly offset by changes in the firm's cost of capital for equity, ROE. In this case, if its ROE increased from 9.4% to 11.9%. This would be the case if debt markets are efficient and a firm is unable to take advantage of any inefficiency in the debt markets. In other words, in the process of any refinancing, a firm would not be able to extract value for its equity investors by increasing returns to equity investors without assuming an offsetting amount of additional risk. Three areas in which we need to be careful when looking at firms with strong earnings growth are earnings growth created by financial leverage, investment, changes in accounting methods. Good earnings growth that creates value for equity investors is the result of changes in the economic and business drivers of the firm's operations. These changes are reflected in the firm's accounting drivers, which are in turn reflected in earnings growth for the firm. This is what we value as equity investors and are prepared to pay for. However, in analysing a firm's financial statements, we need to be aware that earnings growth can be manufactured in a firm's accounts. This is an imitation of the real thing, rather than the real thing itself. As owners of brands such as Coke will tell us many times, beware of imitations. They are not the real thing. So how do we tell imitations from the real thing? How do we distinguish between good earnings growth, which adds value, and bad earnings growth, which does not? How can we ensure we do not mistakenly ascribe value to bad earnings growth? We need to be aware of how earnings growth can be manufactured. One way of imitating earnings growth is through changes in financial leverage. Be careful of firms showing growth in return on equity over time that also steadily increases their leverage. We need to disentangle the leverage or financial activities of a firm from its operations. We need to disentangle the effect of increasing the leverage of a firm on its earnings growth to be able to determine whether there is any real earnings growth taking place. In addition, you may read in the financial media that a firm might have grown its earnings by, say, 50% in the past year. This does sound great. Growing earnings by 50% sounds like a pretty good outcome for any firm. Ryman Healthcare has been a highly successful firm and has been able to grow its operating income after tax, OI, from $13.1 million in 2000 to $647.6 million in 2021, an average growth rate of about 20% per year. If a firm has been able to grow its earnings by 50% in a year, surely something good must be going on in the business. However, what if it transpired that the firm had made a major acquisition of another business during the year and that its growth in earnings was solely due to its having made this investment? Indeed, if we looked only at its original business, its earning growth might be zero. Would this make any difference to the way we viewed the impact of this earnings growth on the value of a firm? Earnings growth through acquiring another business may or may not be as good as earnings growth because of growing and developing an existing business. For example, suppose the equity cost of capital for a firm is 9.4% and the new business acquired is returning 8% on the equity invested in the new business. Although acquiring the new business might result in a large increase in the firm's earnings, it would have destroyed value for equity investors as the acquired business would be returning less than the firm's cost of capital. Equally, if the new business that was acquired returned, say, 15% on the equity invested in the business, and the firm's equity cost of capital was 9.4%, then the acquisition would have added value, and the resulting earnings growth because of the acquisition would be good earnings growth and add value to equity investors. It is a generalization, but often larger firms can tend to grow by acquiring smaller firms. whereas smaller firms can tend to grow through developing and growing their existing business. Ryman Healthcare is an example of a firm that has grown by internal growth, not by the acquisition of other businesses. It started out as a small private firm in 1984. 15 years later, it listed in 1999 with a market capitalisation of New Zealand $135 million. It has subsequently grown into a large firm with a market capitalisation of about New Zealand $7.5 billion. It continues to grow only by internal growth, not by acquisition. Earnings growth could be by way of investment in new acquisitions or by way of investment in internal growth, for example through investment in property, plant and equipment, inventories and receivables. Whether either source of earnings growth adds value to equity investors and is good earnings growth depends on whether the new investment required to support the earnings growth earns more than the cost of the additional capital needed to support the new investment. It is not uncommon for acquisitions by firms of other businesses to add earnings growth and yet destroy substantial value. For example, Wesfarmers acquired Homebase in the UK and Ireland for $705 million in 2016. They also invested significant further funds to restructure and grow the business. In 2018, it sold Homebase to Hilco Capital, a private equity firm, for £1, that is $1.60. It is estimated Wesfarmers destroyed well over $1 billion of value to equity investors in Wesfarmers through this acquisition. This was an expensive way to grow the earnings of Wesfarmers, that is, expensive to its equity investors. Another form of earnings growth to be careful of is earnings growth due to changes in the accounting treatments or policies of a firm. For example, if a firm changes the basis of how it makes its allowance for doubtful debts, say reducing its allowance from 2% of sales to 1% of sales, this could result in growth in earnings. However, this would not add value to equity investors unless it was the result of a change in the economic and business realities of a firm, that is, a change in the actual experience of bad debts. People are paid not to win, but to keep assets under management and stay in the game. The pay structures for most managers have a 12-month horizon, which means that the idea that money managers have the flexibility to look out long-term is contradicted by a basic reality of the business. Henry McVeigh, Morgan Stanley. We saw in Chapter 3 that capital markets can tend to focus on earnings or cash flows in the short term. One reason this can happen is that earnings or cash flows of firms often are difficult to forecast very far into the future, even beyond the current year. So for guys like us, where our capital can be pulled, we have to make sure that we build staying power around our expected value metrics. Emphasizing the quick return of your capital is how you protect the staying power of an investment organization. Mitch Julis, Canyon Capital. If a firm can present its financial statements to show earnings growth in the recent past, this might encourage the capital markets to form the view that this earnings growth is likely to continue in the future. Indeed, psychological studies suggest it is all too easy for us to overestimate the likelihood that an existing trend will continue indefinitely into the future. So it is important to be careful to assess whether a firm's past earnings growth was good or bad growth. Whether a firm's earnings growth adds value or not depends on where the earnings growth comes from. Does it come from investment within a business to fund internal growth, or investment in acquiring another business that provides the firm with a return greater than its cost of capital? If it does, then it is good earnings growth. Or does the earnings growth come from investment in acquiring another business that provides a return less than a firm's cost of capital? such as Wesfarmers' acquisition of Homebase in the UK? Or is the earnings growth simply the result of a change in accounting treatments? Or is it the result of a firm increasing its leverage? If it does, then it is bad earnings growth. Not all earnings growth of firms is created equal. Some earnings growth is certainly more equal than others. Check out the excellent short video, Good and Bad Sales Growth, for further explanation of this important idea in financial statement analysis. 6.4. Levered and unlevered ratios. To complete our discussion of the benefits of focusing on the enterprise rather than on the company, we will look at the relationship between levered company and unlevered enterprise price-to-book PB ratios. We will see that levered ratios include the effects of both the operating and financial activities of a firm. This means they can be influenced by changes in a firm's financial activities, even if there is no change in a firm's operating activities. For this reason, we need to be careful about interpreting levered ratios of a firm. Ratios of listed companies published in the financial media or supplied by the major providers of financial information are usually levered or company ratios. For example, price-to-book ratios are usually based on the listed share price of a firm's equity, the P, and the firm's net tangible assets per share, that is, total assets of a firm less liabilities, goodwill and various intangible assets, divided by the number of shares on issue, the B. A firm's net tangible assets will include both operating and financial assets and liabilities. For example, the New Zealand Stock Exchange each day provides information on Ryman Healthcare, including its share price, trading volumes and market capitalisation, as well as various measures such as price-earnings ratios, PE, earnings per share, EPS, and net tangible assets per share, NTA. See link here. On the 15th of October 2021, the NZX reported the share price of Ryman Healthcare was $15 per share and its net tangible assets was $5.57 per share. From these numbers, we could calculate the levered PB or price-to-book ratio of Ryman Healthcare as 15.00 divided by 5.57, which equals 2.7 times. Similar information is provided on listed companies in Australia and in many other countries. For example, on the 15th of October 2021, Wesfarmers' share price was $54.77 and its net tangible assets per share was $5.08. This gave a levered price-to-book PB ratio of Wesfarmers of 54.77 divided by 5.08, which equals 10.8 times. The websites for the New Zealand Stock Exchange, the Australian Securities Exchange, and many other stock exchanges in the world provide access to a wide range of data on each listed company, including links to individual companies' websites, which generally give access to each firm's financial statements. From all these sources, we could calculate levered price-to-book ratios for listed companies in many countries, based on comparing the market value of equity with the book value of equity in some form. We can express levered and unlevered price-to-book PB ratios as follows. Levered PB ratio equals value of equity divided by book value. Unlevered price-to-book ratio equals the value of net operating assets divided by net operating assets. The levered price-to-book ratio is the relationship between the value of equity and the book value of equity. A firm's levered price-to-book ratio can be changed through changes in financial leverage. It is in part determined by how a firm's operations are financed. The unlevered price-to-book ratio is the relationship between the value of a firm's operations that is the value of its net operating assets, and the book value of its net operating assets. This cannot be changed through changes in a firm's financial leverage, that is, by how a firm's operations are financed. Let us examine more carefully the relationship between a firm's levered and unlevered price-to-book ratios. We can restate a firm's levered price-to-book ratios as follows. Levered price-to-book ratio equals value of equity divided by the book value of equity. And we show some algebra there, and we get to levered price-to-book ratio equals the value of net operating assets divided by the book value of net operating assets, that is the unlevered price-to-book ratio, plus financial leverage, FLEV, times the value of net operating assets minus 1 divided by NOA, the book value of net operating assets. A firm's levered price-to-book ratio equals its unlevered price-to-book ratio plus the effect of financial leverage. In other words, a firm's unlevered price-to-book ratio is its levered price-to-book ratio with the effect of financial leverage removed. If we think a firm's financial leverage does not affect value to equity investors, then a firm's unlevered price-to-book ratio will give a clearer indication of the relationship between market and book values for a firm than will its levered price-to-book ratio. See the great video Levered and Unlevered Ratios about this important distinction between levered and unlevered ratios. In our simplified illustration of Ryman Healthcare in section 6.2 above, the firm's value of net operating assets equals $8,634.5 million. This is based on market-based measures. Its unlevered price-to-book ratio, value of net operating assets divided by NOA, the book value of net operating assets, equals $8,634.5 million divided by 4,576.3 million, which equals 1.9 times. Ryman Healthcare's unlevered price-to-book ratio would be unchanged with a change in the level of financial leverage. It would remain at 1.9 times. However, with a change in leverage, the levered price-to-book ratio increases from 2.7 times to 2.9 times. A firm's levered price-to-book ratio will equal its unlevered price-to-book ratio when it has no financial leverage, that is, financial leverage equals 0, or where its unlevered price-to-book ratio equals 1. If the book value of a firm's net operating assets does not accurately reflect the value of a firm's net operating assets, that is, unlevered price-to-book ratio does not equal 1, as is usually the case, and if the firm has some financial leverage, which is also usually the case, then a firm's levered and unlevered price-to-book ratios will be different. This relationship can be expressed as follows. Value of equity divided by book value of equity equals the value of net operating assets divided by the book value of net operating assets plus FLEV times the value of net operating assets minus 1 divided by the book value of net operating assets, which equals 1.9 plus 0.81 times 1.9 minus 1, which equals 2.7 times. And when we increase the financial leverage of Ryman Healthcare from 0.81 to 1.13 times, its levered price-to-book ratio was increased from 2.7 times to 2.9 times. This increase in the levered price-to-book ratio was solely due to the increase in Ryman Healthcare's financial leverage. The unlevered price-to-book ratio of Ryman Healthcare remained unchanged at 1.9 times, being unaffected by the change in leverage, as both the market value and book value of its net operating assets are unchanged as a result of the change in leverage. This relationship can be expressed as follows. Value of equity equals book value of equity which equals the value of net operating assets divided by net operating assets, value of net operating assets divided by the book value of net operating assets, plus FLEV times the value of net operating assets divided by net operating assets minus 1, which equals 1.9 plus 1.13 times 1.9 minus 1, which equals 2.9 times. If the book value of a firm's net operating assets in OA accurately reflects the market value of its net operating assets, i.e. the value of net operating assets divided by the book value of net operating assets equals 1, then a firm will also have a levered price-to-book ratio equal to 1, regardless of the firm's financial leverage, net financial obligations divided by book value of equity. Intuitively, this makes sense if a firm's net financial obligations are also at their market value in a firm's accounts. As a firm's book value of equity equals net operating assets minus net financial obligations, then if both net operating assets and net financial obligations are at market value, then a firm's book value of equity will also be at market value. However, when the book value of a firm's net operating assets does not accurately reflect the value of a firm's net operating assets, as is usually the case, then a firm's unlevered price to book will diverge from 1. For example, Ryman Healthcare's unlevered price to book in our simplified illustration was 2.7 times. In other words, the market value of its net operating assets was greater than the book value of its net operating assets. Although Ryman Healthcare's financial leverage was at about average levels at 0.81 times, the difference between the market value and book value of its net operating assets with an unlevered price-to-book ratio of 1.9 meant that an average level of FLEV, financial leverage, resulted in the firm's levered price-to-book ratio at 2.7 times being somewhat higher than its unlevered price-to-book ratio of 1.9 times. By increasing Ryman Healthcare's financial leverage from 0.81 to 1.13 times, we were able to increase the firm's levered price-to-book ratio from 2.7 times to 2.9 times, with its unlevered price-to-book ratio remaining at 1.9 times. A firm's unlevered price-to-book ratio indicates a firm's level of expected future abnormal operating income. Under our enterprise economic profit framework, the present value of abnormal operating income is the only factor that results in a difference between a firm's value of net operating assets, the P, and its book value of net operating assets, the B. On the other hand, a firm's levered price-to-book ratio also includes the effect of financial leverage effectively interacting with a firm's expected future abnormal operating income through its unlevered price-to-book ratio. The relationship between a firm's levered and unlevered price-to-book ratios is set out in Table 6.1. The key takeout from Table 6.1 is that, except in the special case where a firm has an unlevered price-to-book ratio equal to 1.0, that is, the book value of its net operating assets equals its market value, financial leverage will impact on a firm's levered price-to-book ratio. Where a firm's unlevered price-to-book ratio is greater than 1.0, the right-hand side of Table 6.1, and a firm has some financial leverage, a firm's levered price-to-book ratio will be greater than its unlevered price-to-book ratio. Where a firm's unlevered price-to-book ratio is less than 1.0, the left-hand side of Table 6.1, and a firm has some financial leverage, a firm's levered price-to-book ratio will be less than its unlevered price-to-book ratio. Of course, where a firm has no financial leverage, its levered and unlevered price-to-book ratios will be the same, regardless of the level of a firm's unlevered price-to-book ratios. The levered price-to-book ratios of a firm will be affected by the amount of the firm's leverage. By increasing a firm's leverage, you can increase or decrease its levered price-to-book ratio even though its unlevered price-to-book ratio remains unchanged. This means that a firm's levered price-to-book ratio is influenced by both the extent to which the book value of a firm's net operating assets diverge from their market value, that is, a firm has either positive or negative expected future abnormal operating income, and the level of a firm's leverage. It is usually a firm's levered price to book that is referred to in the financial media, often in the form of a levered price to net tangible assets. If a firm's levered price to net tangible assets was relatively high, say 2.5 times, see shaded cells in table 6.1 above, what does this tell us? Well, if the firm had a relatively high level of gearing, say financial leverage equals 2.0, then the market would be saying the firm's net operating assets was somewhat undervalued in its financial statements. That is, unlevered price to book equals 1.5. In other words, its relatively high equity value compared to the book value of its equity was largely due to its high level of financial leverage, with only a relatively smaller part due to the level of expected future abnormal operating income of the firm. Alternatively, if the firm had a low level of gearing, say financial leverage equals 0.5, and its price to NTA was 2.5 times, then the market would be saying the firm's net operating assets was more significantly undervalued in the firm's financial statements. Unlevered price to book equals 2.0. In other words, its relatively high equity value compared to the book value of its equity was largely due to the level of expected future abnormal operating income of the firm, with only a relatively small part due to the firm's level of financial leverage. What this means is that it is not possible to interpret a firm's levered price-to-book ratio without also referring to its level of financial leverage. Unlevered ratios of a firm can also be referred to as enterprise ratios. I could say a lot more about levered company and unlevered enterprise ratios. For example, just as the financial media and various providers of financial information will usually refer to levered or company price to book ratios, so they will also usually refer to other ratios as levered or company ratios. Levered or company price to earnings ratios are usually referred to in the financial media. Similar considerations apply to interpreting levered PE price to earnings ratios as applied to interpreting levered price to book ratios. Levered price to earnings ratios need to be interpreted in the light of the impact of a firm's leverage on its earnings. In this section, we have looked at the relationship between levered company and unlevered enterprise ratios by focusing on a firm's PB price to book ratios. As we can focus on the enterprise rather than on the company in our financial statement analysis, so we can also focus on unlevered enterprise ratios rather than levered company ratios. In this way, we can disentangle the effect of financial leverage on a firm's ratios, such as its price to book and price to earnings ratios. Conclusion. This chapter has looked at how we can simplify the task of financial statement analysis by ignoring how a firm has financed its operations. We saw how we can restate the economic profit framework to make it simpler, as follows. Value of equity equals the book value of equity plus the present value of abnormal operating income. This works if a firm's net financial obligations are at or close to market value in its balance sheet. We also saw that the risks of a firm's operations can be seen to drive a firm's cost of capital for equity and for debt, rather than the other way around. The risk of a firm's operations relative to the risk of alternative investments in the equity and debt markets can be seen to be what is relevant. A firm's equity risk and its equity cost of capital has two components: operational risk, weighted average cost of capital, and financial risk, comprising leverage, value of debt to value of equity, and spread, weighted average cost of capital minus rho D. We saw that as a firm increases its leverage, its equity cost of capital will usually also increase, as will its return on equity, ROE. And that if debt markets are efficient, the effect of each on the value of a firm can be expected to exactly offset each other. In other words, if these two effects of a firm's leverage exactly offset each other, the financing of a firm between debt and equity will have no effect on the expected future abnormal earnings of the firm and have no effect on its value. We also looked at how we need to be careful to assess whether a firm's earnings growth has been manufactured by changes in financial leverage, poor investments, or changes in accounting methods. And we also examined the relationship between levered and unlevered price-to-book PB ratios and how a firm's leverage can impact on its levered ratios. We noted that the financial media usually refers to levered ratios, such as PB, price-to-book, and price-to-earnings, PE ratios, and that these ratios needed to be interpreted after considering the level of a firm's leverage. Focusing on the enterprise or a firm's operations rather than on the company or a firm's equity can simplify our financial statement analysis by focusing on those activities of a firm most likely to be adding value to its equity investors and to its other stakeholders. Focusing on where a firm is most likely to be adding value can help us better analyse the key drivers of value of a firm. It can also help us to not be deceived by the financial activities of a firm, such as increasing financial leverage, which might appear to be adding value when they are not. To focus on the enterprise, on a firm's operations rather than on the company, can have many advantages. It can significantly simplify our forecasting task, as we will not need to forecast a firm's financial activities. We will also see in Chapter 7 that by focusing on the enterprise, we do not need to adjust our measures of the cost of capital as the leverage of a firm changes. As we look in Chapter 7 at the significant challenges of extending our forecasts beyond our horizons, beyond how far we can reasonably see ahead, as we spread our imaginations into eternity, we will see that the advantages of simplifying our forecasting task by focusing on the enterprise becomes even more valuable. This can all make the task of forecasting a lot more doable in practice. We should seek simplicity and distrust it. Simplifying our analysis by focusing on the enterprise has many advantages. Yet here is a word of caution. The extent to which we can make this simplification in the way we look at a firm depends on whether a firm's financial activities are materially adding or subtracting value to the equity investors in a firm. In business and in financial statement analysis, simplification and focus can be powerful, with one caveat: if we are not leaving out or failing to see something that is significant.